Samir Arora joined us now. Samir, good morning. Thank you for joining us. Samir, if you look at Friday's trade in isolation, bad day, horrible day, poor day, oh my God, markets really sold off. But I put things in context after a 15% run up in the budget, it will appear like one bad day.
Exactly. Actually, you want those days to have happened in February itself, because otherwise you'll have a great February, and then as a fund manager, we want consistency. I was very happy that if that is a correction, it is best done in Feb, where you still have near double-digit gains for the fund and everything. So I think if it is a correction, I think that is what it is. It's good that it happened in month of Feb. You don't like months where, as a fund manager, we are not only trying to maximize the returns as of today, but also worrying about a new investor who may have just come in or who comes in tomorrow. Even as an individual, I don't think it is great to have everything happen in a very short period of time, because you will be investing again and again, month after month. So steady returns are always more welcome.
How much importance would you pay to all the spike what the US 10-year paper has seen? I know all kind of discussions and debates have happened over the weekend, but for our viewers and for Indian investors, do you think this is just a momentary risk adjustment and we should look beyond this?
I think we should, and I read a number of reports from foreign brokers on this topic, and the conclusion is that in the past, if you look at the data, so if you look at, say, 2004 to 2006, you can see it on online, at least the data part, is that the interest rates were hiked 17 consecutive times in the US. And they peaked at, I think, 5.25% or something from 1% in 2004, something like that. Basically, 17 times the rate was increased, and that is a total of 4.25%. And our best period in our life has been 2004 to 2007 kind of period. If we look at this day-to-day 10-year bond going up and down, the general conclusion is, which I agree after reading 4-5 reports, some saying different things, is that if the rates are going up because the economy is improving, then it is going to happen, because pre-COVID the rate was something like 1.8, 1.9%. And so you can't have a scenario where we are trying for an unlocked trade, and then there is a stimulus, and then there's a cyclical recovery, and then be totally surprised that why the rates are going up. But if it is that the government, the Federal Reserve says, or the policy rates are different, which means the policy has changed, even that, as we saw in the 2004-06 period and maybe many other periods, it doesn't matter if you can position it as if the market can position it that this is because the economic recovery is good and it is only mean reverting to what it was before. And therefore, I don't think this negative will be the main reason why the markets will fall, if they do.
So for a minute, Samir, if we take a pause and say two things have happened. Global interest rates plunged post-pandemic, global liquidity was printed in abundance, and global interest rates have come back. Can you put things in context for us? Because rates have come back, but the underlying flow of liquidity is huge. So liquidity is still there. Where will that move?
So first thing is rates have not come back all the way. In the US, the rates pre-pandemic were 1.9% for 10-year. It went down to something like 0.5, and now it's 1.4, 1.5. So as of now, let's say, without worrying about the real guys who follow US market, big picture, if everything, the economy and everything is supposed to go back to pre-COVID levels now or in the next few months, then it is reasonable to say that by November, December, third quarter, fourth quarter, that the US rates will go back to what they were pre-COVID. But in between, you have got this extra plunge of extra liquidity, and the Federal Reserve is saying right now that they are comfortable with it, and therefore this party will go on, and then over time they have to gracefully withdraw, and then we see what happens. But that may not happen for even a year or more. And then it depends on the path. If they say that we are first not buying new bonds, and slowly they'll say we'll withdraw 25 billion a month of bonds and all that, At that time, whatever is the situation of the economy, the market, then they'll have to, maybe temper it down, they have some phase where they can do it faster. Someday, as everybody agrees, that this liquidity has to be withdrawn. But if the Federal Reserve themselves say that we are not doing it now and we are not doing it for the near term foreseeable future, that means say next, say 9 months, 12 months, then no. We move on in life for the moment.
Sure. Samir, in terms of the kind of cut we saw on Friday, if that's an indication of if anything to come, everyone's been talking about how India is poised as the key emerging market. The interest is brewing here, but it also exposes a vulnerability. How much do you feel that domestic investors will really be able to cushion the kind of selling pressure we may witness, even if not immediately down the line, if there continue to be concerns or volatility around what's happening there on bond yields or otherwise in the US?
So first thing is that right now we are totally dependent on the foreign investor because the domestic guys have been selling for 9 months. So they should say that we hope that the foreign investors continue to invest. In the meantime, the domestic guys feel that maybe they're overdoing their selling and they stop and then they buy. So actually the positive thing could be that we don't have everybody who could buy stocks in India buying right now. In fact, there has been basically an effective, for the last maybe 7-8 months, massive selling by foreigners and equally massive selling by domestic funds and massive buying by foreigners to keep at least those flows more or less balanced. So India is in a slightly better spot these days because we all believe that the budget was good. But even to continue with that, you will need the support of both foreign and domestic investors. Right now, the first trade, which was related to the budget and that the market will go up, has played out very well. Right now, what we are doing is, because we are also thinking that these totally future-looking, forward-looking digital plays, consumer plays with 70 multiple, all those we have to reduce that and buy a little bit more of, for us, financials, which we already had very high. And we've added even more on Thursday and Friday, and maybe increase it by 4-5% to nearly being half of the fund.
Okay. On some of the, while of course, we're still looking at an uptick in demand overseas or back home, given, for example, what we're talking about this morning and the auto sales number, there seems to be some plateauing of demand that's coming in, at least on discretionary. Do you see that as a trend? Because we were actually watching out for an uptick, particularly on the urban front, but, some signs as to whether or not consumption will really pick up.
Well, as I have been saying, I don't think there is a recovery in this. This is all pent-up demand. Even if you look at the paint industry, for example, you will have high numbers, but if the total paint demand for the 2 years does not change, and all that happens is that the paint in the growth that was supposed to happen, say in the COVID period, has got postponed to now, then by definition, even if the overall demand is the same, when you look at it, purely on a year-on-year number, the numbers will be lower. I'm talking about paint in the sense because paint looks like having a defined market that so many people want to paint, and it got postponed and nothing else happened to it. Similarly, in cars and all, I have always maintained we don't have any auto stock other than a truck, HCV, because basically we think that the industry has been disrupted. If you don't believe it, it is in today's Singapore papers also, that over time we are going to become a car light economy. We means not India but the world in general. And my whole thesis is that a large number of stocks do well, like 70, 80, 90, 100 stocks do well each year. Therefore, we will buy only those stocks which we believe have both a big picture, longer term story and a shorter term story in terms of general month to month or year to year numbers. There is no need to say, because for example, many people tell me, oh, you did not buy this auto stock and it was up 25%. I said, true, but it is not that money was kept in a bank and therefore we lost 25%. We bought something else, and maybe that also went up either 20% or maybe 30%. Because the point is, we will buy what works for us in terms of rational analysis of both long-term and maybe month-on-month numbers, but not only month-on-month numbers.
Samir, each time we only talk about equities, we've never asked you your views on Bitcoin. I see that you were very intrigued by what Bill Gates has to say about Bitcoins, that if you don't have as much money as Elon Musk, perhaps you're better off staying away for it. Are you endorsing his view?
I am totally endorsing because I'm an old foggy. But if you want a nasty one on this, then I was seeing yesterday Charlie Munger's interview when he's the chairman of the Daily Press Journal, whatever it's called. And so they asked him, between Bitcoin and Tesla, what would you choose? He said, between a flea and lice, which one is worse? So, we are old foggies. We don't believe a bit of this Bitcoin because nobody has been able to tell me in plain English what is the benefit other than saying you can transfer money, which I guess we can do without any cost anywhere in India. And if you say that you will do it internationally, that mostly the governments will come in and stop. And if, as I was reading, who wrote that, I forget. I think it was one of these. But the biggest risk in Bitcoin is that it is too successful and that the governments clamp it down. And, you can't really seriously think that you can fight the governments, and there's no way governments will allow it. But forget about the government for the moment. Even before that, there has to be some logic other than the fact that 5 million people want to buy it.
I can't get over what Charlie Munger had to say, but yeah. So, Samir, are you tempted to buy the current decline in the markets if it gets worsened? And if so, what would you do? Would you buy more of the same?
As I said, we already did on Thursday, Friday, but more than that was a shuffle, which was to say that very high PE companies by definition get hurt because if the interest rates have to go up. And don't say in India they are not going, they are going up in the US. We are all just copycats. The good thing about us managing US money is that broadly we see what is happening there, and plus minus 25 days it happens in India. It has been for 25 years my story. You don't need anything more than just understanding which kind of stocks are doing well in the US and adapt it to India. Or maybe to other markets also, but I don't do other markets, as in specifically doing Korea or Taiwan or something. So broadly, we have also bought. We bought there also, and we bought here also, even more financial. So we had maybe 40 to 43% in financial. Now we have maybe 48% in financial.
Samir, October has been good, December has been decent, January okay, February volatile. What kind of market do you think we are in for rest of the year? Because it may not be a trending market, but do you think it will be a volatile market? Will it be a trending market? What is your sense on the way, how directionally, which way the market arrow will move?
See, I don't think, by the way, January was otherwise a sort of a down market. Feb was a great market. But in general, I would think that you cannot have a one-way market anymore, because now is where the tension will come between the fact that you may have economic growth, but the market is not growing. That has happened many times in the past, not in India, but in general, it has happened many times, and maybe in India also. Many times it has happened that the economy is doing well, but because then people find other places to put their money. If the real estate is doing well, maybe 10% of public wants to go and buy real estate. There's so many things that can happen where interest rates, if you see all the times where we've all got hurt, is because we were only looking at our stocks and saying that this earning is going to be good. So if you look at 2008, HDFC Bank earnings grew 32%, I think, that year. And the stock fell 52% in rupee terms, and in dollar terms, because the currency itself depreciated some 19% in 2008. Effectively, our number one holding was down 60%, while we were feeling happy and telling the world that, see what great stock we have found, because it has grown its earnings 32% or 30% that year also. There has to be a mix and match of macro and micro up to a point. And I feel that this time the macro analysis will have to be a little bit more, because these flows and all are coming from a macro angle. Nobody's really overly analyzing India versus others when they say we are putting in emerging markets, and then some are putting it specifically in India. But what I mean is, when we say that this year is the year of emerging markets and this is the year of dollar weakness, that effectively is all macro analysis. And the macro will be driven by what the people in the US think about macro. So we'll have to worry about all these things now: new preferences, interest rates, 10-year bond, blah, 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 even Bitcoin. Because if Bitcoin and Tesla were to fall, even though both look absolute bubbles to me, almost by definition, many other stocks which are in the same camp as Bitcoin being just a high beta NASDAQ stock, it will be difficult to say that these things fall 20%, but a stock which is trading at 100 times in US doesn't fall. So it's going to be more difficult, but at least the start has been good thanks to Feb.
Would you advise should be a better portfolio strategy? Hedge your bets, have a defensive exposure, because if you bought into, let's say, metal and banks from October to Jan, October to Feb, that trade has worked beautifully.
So for us, because we don't buy metal, for us only the banks have to take all the workload. But in general, we are not going to change that strategy, that we need two kinds of stocks. One is stocks where we have high confidence, but therefore the returns will be lower. And one where we have a little less confidence, but if it is right, the returns will be higher. And it's a mix and match of that. Why after 25 years, you will not find many people being able to continue in their jobs, because they get blown out because of taking very aggressive stands one way or the other.
Samir, now you like financials, but let's split the financials into 2 or 3 large buckets, not the good old private versus PSU. You've got big size corporate banks, which includes ICICI Bank, IndusInd Bank, even SBI. Then you've got the old private sector banks, which includes the likes of, let's say, a Federal Bank, Karur Vyasa Bank and others. And then somewhere in the middle, you've got the new banks, Bandhan Bank, AU Small Finance Bank. What's your idea on all the 3 categories I mentioned?
Okay, so in our case, we don't have any of the old private sector banks, because those banks have always presented value but have nearly never delivered, and 25 years later we are not going to try them one more time, which are these old banks which were regional banks but for whatever reason were not nationalized. We have not bought any of them. So we have first the big 4, and then we have 1, 2 of these sort of turnaround kind banks. We have one big State Bank of India. We don't have any PSU bank other than State Bank of India, because we say we are bullish on India, but we don't have to be so bullish that we'll believe every great thing that is supposed to happen, because half the time those great things don't happen while the market and the country still does well. So that's why over the last 7-8 years, I say, for example, I won't buy pure infra plays and I won't buy pure PSUs. Once in a while we do, but generally in a big picture sense. Because if those things happen on time, if those things happen with cost control, without getting into any crisis, that means the country is doing super well. And if it is doing super well, then everything else that I own also will do well. But most probably what will happen is that infra projects will get delayed and privatizations will not happen, but still overall market will do well. Therefore, we say we are very bullish, but we don't have to be extra bullish.
Sense. Samir, in light of that, do you think it's going to be a sort of average year in terms of returns, low double digits, or do you expect something even better than that? I mean, just given the kind of momentum we've seen even through the difficult year that was 2020, it's raised expectations somewhat. But, you know, given what you also just described, it makes sense to perhaps temper those expectations somewhat?
No, first thing is that if you really think that we are going to get mid-teen, that is 15-16%, that is super bullish. and I am in that camp. So what I say is that if you believe that the returns will be, say, 12, 15, 18%, that is a great expected return to put as much money as you can. And if you get higher return, we are not going to refuse it. We are not going to sell stocks and say, sorry, our budget for this year was only 14, 15%. But 14, 15% these days is a great return considering what you get in alternative assets and what you get in other countries. It's a great return if that can be assured. The only thing is, right now we have already made 10% in Feb. So I will not count that, and I will say from here on, give me another, because otherwise, it's only 5% left, which would be disappointing. But as a rolling basis, on a general rolling basis, I would think that 15% is the average expected return. So there has to be some reason to say, because that has been the historical return based on even, you can say, GDP nominal terms, and they're a little bit higher because the private sector is taking share from others and the PSUs and other things. And therefore the corporate sector earnings will grow X, and by selection I can get 15, 16% return. So to say that this year it should be 25% or something, there should be some extra logic for why this year is special. And those things can happen if everything works smoothly. I think, for example, if Air India is sold and BPCL is sold, those are such dramatic announcements that you will get more money from foreign allocators and stuff like that. But in a general context, 15% return is a great, great return. And anytime you make much more than this, mostly would mean that you will make less in the following year, because the end return is going to be in this range. You're not going to have 30% per annum years for the market. You may have for some individual here or there.
Absolutely. Samir, great to chat with you this morning, and also to hear that you're still very bullish on the areas of interest that you're looking at. Always a pleasure. Thanks so much for joining us.